Good evening, everyone. A warm welcome to all of you to the launch of our first NFO of 2023, presenting NFO of ITI Flexi Cap Fund. I am Sadanand Pai, handling marketing and communication at ITI Mutual Fund. It is always a pleasure to connect with our dear partners. Thank you all for joining in. Before we begin, let me introduce you to my colleague, Ms. Urusa, who will be my co-host for this evening. We would like to share a good news with all our partners here today. Urusa, can you guess? What's the good news?
Yes, of course. Mutual fund industry has crossed the milestone of rupees 40 lakhs crores. Congratulations to all our partners for achieving this.
That's so true. It is indeed because of our partners and their investors that mutual fund industry has hit new high. And so is with ITI Mutual Fund. We are pleased to share that ITI Mutual Fund has crossed the AUM of 3,557 crore, and the credit goes to our 19,000 mutual fund distributors spread across the country and the commendable effort by our ITI Mutual Fund team.
That is absolutely amazing. So let's hear it from the man himself who has been associated with ITI Mutual Fund since inception, our acting CEO, Mr. Hitesh Thakkar. I now hand over the call to Mr. Hitesh Thakkar. Thank you and over to you, sir.
Thank you, Urusha. Actually, this achievement wouldn't have been possible without the support of our privileged partners and our 200 employees who are working very hard. Efforts from our investment team are visible now as most of our scheme performance has improved over last 9 months. As you all are already aware, Mr. Rajesh Bhatia has joined us as a Chief Investment Officer of ITI Mutual Fund during last month, which gives us an immense confidence of creating positive experience for our investor and partners. And of course, goes without saying, the guiding light to all and the torch bearer, our founder, promoter, and distinguished industry persona, Mr. Sudhir Valia ji. Thank you, Sudhir sir, for joining us. I request you to share your valuable thoughts and words of wisdom.
Thank you, Hitesh. Friends, welcome you. We thank you all. We thanks all our investors, partners for been supporting us for the last more than 3 years. We will be working for definitely giving you a differentiated product offerings, transparency, and will have an excellent experience of investment. We have a very matured senior management team working for the investment, and I'm sure that they will manage your money prudently and they will ensure that you will have a risk-adjusted returns. I am very confident of our team, and I am sure that they will deliver as per your expectations. I am looking forward for your continuous support, time to come, and contribution in this NFO with the full support.
Thank you very much, Sudhir sir and Hitesh sir, for your kind words. Moving on to the main event of this evening, the launch of ITI Flexi Cap Fund. Can we have the AV, please? I now request Mr. Rajesh Bhatia to take us through this new offering, as our partners are very excited to hear from you. Over to you, sir.
Great. Thank you, Sadanand. A warm welcome to everyone on this call. I'm extremely excited to bring to you the ITI FlexiCap Fund. I'd like to begin this presentation by making an observation of the changes that are taking place in the business world. I don't know if you are noticing, but the world is changing dramatically. Today, we are ordering our food and grocery from an app. We are ordering our taxis by an app. We are watching television on streaming videos offered by various participants. And we are driving electric vehicles compared to the ICE engine vehicles. Clearly, the business and business models are changing. Therefore, companies which adapt to this change will evolve and grow. On the other hand, companies which fail to adopt will fail and go into oblivion. So what does it mean for us as equity investors? That companies who actually evolve to this change will go from mid-cap, small cap to large cap. On the other hand, there will be businesses which fail to adopt, can go from large cap to small cap. There is yet another observation that I want to make as an investor, that returns across market caps are not synchronous. What I mean by that is large cap, mid cap, and small cap sectors, they do not move in unison. You can see that from the table in front of you. Also, if you notice, if you look at the last 5 years, you can see the differences in returns. So for instance, while financial year 2019, the large caps did significantly better than the small cap, if you look at the last 2 years, which is financial year 21 and 22, small caps have done significantly better than the large caps. So how do you take advantage of all of this? The answer to that is flexi cap portfolios. The flexi cap portfolio gives you the steadiness of a large cap, but equally it energizes the portfolio with fast growing small and mid cap portfolios, companies. What does flexibility mean? For an athlete, it means muscle strength and endurance. On the other hand, flexibility for a fund manager means the opportunity to take advantage of the mid cap, small cap, and large cap diversions, and therefore an ability to express his talent and spot ideas. Therefore, he can mold the portfolio according to his judgment. Not surprising then, flexi-cap portfolios are the largest category of AUM in the mutual fund industry today. How are flexi-cap portfolios different from large caps or multi-cap funds? In the multi-cap funds, or in the multi-cap funds, you have defined allocation to large cap, mid cap, and small cap. Whereas in the flexi-cap portfolios, the fund manager has full freedom to exercise the proportion of investment that he wants in large cap, mid cap, or small cap funds. Also, so to conclude, a flexi-cap portfolio will optimize the market and the portfolio construction opportunity. It is flexible, dynamic, and diversified. To share further insights on this and our strategy in the ITI Flexi Cap Fund, I am now excited to invite my colleague Dimant Shah to take this presentation forward. Over to you, Dimant.
Thank you. Really, it's a great times to be investing in. Recent times has been, amazing. We saw what happened in the US markets. We saw how stable the Indian markets are. And overall, I think we are going from strength to strength, even in this very vitiated kind of environment. Overall, I think so. There are some few headwinds that the markets, there are many people who have procrastinated different set of scenarios. But the scenario that we would want to align to is that recently, I think in the just concluded calendar year, I think the markets returned 4-5%. I think almost a similar kind of journey would be captured by the market in the ensuing year also. The markets will be divided into two halves. The first half will be slightly more vicious. Second half, I think the earnings would be catching up in a phenomenal way. And why we say so is that we feel that as we move into the calendar year, I think so the inflation globally is expected to come down. And possibly by give or take by May, June, we should even see Fed fund rates being slightly more accommodative than they are in the current scenario. So, the first half possibly will be slightly more volatile, slightly more vitiated to an extent. But as the earnings catch up and as we kind of get over a multitude of headwinds, I think the second halves would be subject to kind of earnings coming back very decently across most of the sectors. So I think, we have already witnessed logistics costs coming down, the oil prices cooling off, the commodity prices also coming off. So all this is somewhere going to be far more accommodative than what we witnessed last year. Just to again say that, okay, we have been witnessing 21-22% operating profit margins for corporate India overall. Last year, we came down to about 15-16%. And slow and steady, possibly the entire basket would move back towards 20-21%. But, give or take, it might take 1 year, 2 years, but maximum in our opinion, possibly in another 2 years, we should be back to almost the earlier trajectory. So next, please. So clearly, I think so, we saw the central banks across the world pump priming the economies and printing money. And this was the fastest pace of rate hikes that we have seen post early 70s when a similar scenario had played out. And now when they withdraw, so what that caused, the offshoot of that was actually asset prices worldwide, different asset prices. So surplus supply of money led to, bump up in many asset prices, including real estate. And now as the withdrawal takes place, we will possibly be, it might be still be very punitive to certain asset classes. And we have seen the bond yields kind of moving up, to align themselves to the also it is kind of procrastinated that Eurozone will face more difficulty and more challenges as opposed to US. And clearly, I think this first half will more or less decide. At a very macro level, all it means is that supply needs to catch up with the demand already being very ingrained. So to an extent, I think so, as supply chains settle, as commodity prices settle, as logistics settle, the scenario will be meaningfully reasonable. Even yesterday, the inflation reported is kind of slightly more accommodative than what most of the players had anticipated. So as we get into the ensuing year, I think so we will see more and more favorable conditions. So hopefully, next please. So I think as far as India is concerned, we face challenges because of supply chain. We face challenges because of high oil prices, commodity prices, and also the viciousness because, somewhere the exports were getting stagnated, but the imports were not abating. So as things stand today at $75, I think we are facing a gap of about $250-275 billion. Give or take, it is the current account deficit has crossed about 3%. And, the earlier base of the currency, which was, behaving very smoothly and nicely between 72 to 78, it got uplifted and, it kind of settled or appears to have settled between the next leg of 78 to 83, 84. So perhaps as the conditions get more favorable, we'll see less and less pressure. Plus further FDI and exports, as the exports catch up, I think this pressure should also abate. So clearly, I think so oil being amongst the biggest, oil plus energy of various kinds like coal, these two items account for a large amount of import. And with the pressure coming off, I think considerable tailwinds as far as India is concerned. Next, please. So I think many people have said that, India will stand out, has stood out. And even in the ensuing year, to my mind, I think so, I would not be under any iota of doubt that India will stand out. It may appear to be a very small return in terms of the calendar year 4%, but really, if you look at most of the other countries, they are not even close by if you take all the 3 years together. So really, I think we have done great efforts. And, I think the ensuing period also appears to be. Now, the only caveat in this statement would be no geopolitical event which can, seemingly upset the entire. So no further geopolitical event should lend itself to this environment. But for which I think so the picture looks slightly better even than the last calendar year. Next, please. So this is a acronym coined by many guys, and that we are an OSS. And sooner or later, I think even in the recent past, if most of you have read the newspapers, quite a few CEOs globally have kind of come to the conclusion that not only this decade but possibly this century belongs to India. So now step back and kind of just take a look that industry after industry, possibly India is second to none. And when we started, just to recall, when we started the reforms process, the interest rates, the import rates, duty rates were meaningfully high. Today at the ASEAN duty rates, we are second to none in most of the industries. We are the third largest in auto pack, which is, amazing achievement for our economy, which is still not even doing $3,000 per capita. We are the lowest cost producers of cement, pharmaceuticals, most of the non-ferrous metals, partly ferrous metals, and so on and so forth. So, and software, of course, the main industry that put India on the global map and, kind of brought attention or got attention of the world. So clearly, I think so. If you look at the picture, I think the stars couldn't have aligned more better. It's only for us to take this journey more surely and at a speedy rate forward. Next, please. So clearly, I think if you step back, I think post demonetization, the government has been very encouraging to meet so many things they have done, the benefits of which are kind of visible to the world and also us. Just to start, I think COVID, we were amongst the most efficient, inoculators of the entire population, and and feat which has not been achieved by even many advanced countries. The PLI, I think this is a very important step by the government to further enhance the productivity and the manufacturing base in the overall share of the GDP. Currently, the manufacturing side of the GDP is about 18%, and 52% is services, and the balance is agri. Now, what this PLI scheme, if carried out flawlessly without any trouble, then it can possibly raise the production levels by about, it is anticipated, and kind of there is a guesstimate which says that about $450 to $500 billion would be the further enhancement of productivity. If that is the case, then the entire manufacturing base moves up from around 18% to 23-24%, and that's no mean achievement. So clearly, I think so we would be doing really great justice to the entire manufacturing base. Second, it would also mean that we kind of fill in the jobs. Third, the world will be looking at us and further boosting FDI and so on and so forth, which will be further helpful, because I think world is already started looking at an alternate to China in terms of both production base and sourcing base. So clearly, I think this is a very, very important step by the government. Forex reserves at 565 cover about 8 or 9 months of imports. There are certain repayments that are to happen in the short term. That could be a small blip, but I'm sure that, we will tide over that problem as well. The exports are stuck around $450 billion. The imports are around $700 billion. So this gap needs to be bridged. And as an offshoot of PLI, possibly even this will go strength to strength. Corporate balance sheet, again, very spick and span. I think pre-COVID, we were around just 1 or 2 years ahead of COVID, we were around 65-70% leveraged. Today we are at 50. The estimates are that we are around 50%. So the corporate balance sheets have not gone into big time capexes, but possibly deleveraging and in preparation for the new capexes as and when the opportunities do arise. Although when you study the large groups, the average capexes have already signaled that they are on a takeoff stage. Also, to add to this, possibly we'll see about 8 or 9 state government elections. Ahead of the elections, we normally witness reasonably strong spends in various sectors by the state government and the central government. So clearly, I think so capex would be an important area which will further enhance the overall productivity. In the IBC code, again, has been very helpful, and the government is also trying to remove certain more cobwebs so to speed up the entire process, and this only adds to the manufacturing base that we currently have. And overall, if you take the year 2000 as a base, corporate profits have been growing at about 13 or 14%. That's also happens to be the CAGR in the Nifty earnings, and the Nifty has given that kind of a CAGR. So clearly, when we say that the acronym that is always coined is that the earnings will be following the Nifty will be following the earnings trajectory, and this is so very true. Taxation reforms, again, I think we are at the global rates of taxation around 25% for the corporate. And so this would be extremely helpful, in my opinion. So I think so the corporate tax rate has been cut to 22%, and introduction of GST, digitization, and various other steps that the government has taken. Today, even land records in quite a few states have been digitized. So earlier people could sell the same piece of land twice, thrice as many times. Today, that's almost visible on the digital records. So even we would have witnessed in the current assessment here that the AIS information that the government has mapped in our own individual tax this has been astounding. The amount of information now that they have and are able to map with every ensuing year is just phenomenal. So I think these various steps, we have witnessed record tax collection also, be it GST or income tax, and that gives a great amount of fiscal room to the government as well. So I think amazing amount of reforms and base is happening. The India Inc. as a country is just on the runway, willing to take off, and possibly the offshoot of this entire journey is what we will witness in the future years. Next, please. So very slowly and silently, in less than a couple of years, I think our weight in the MSCI has doubled, and largely it has come at the expense of China. And This will mean that some of the not active but passive funds get assigned to come in by way of flows. So clearly India is slowly but surely finding the right metric and its right place amongst the major nations globally. Next, please. So just to reiterate what the earlier points, I think just take a look that the first column, the global financial crisis, the inflation was at almost 8%. FDI flows were insipid compared to our GDP. Corporate debt was almost at 64-65%. Forex reserves were virtually half. And look at the scenario now. Inflation much more controlled, exports more robust, FDI flows we have been witnessing in the recent past anywhere between $50 to $100 billion of FDI flows. Corporate debt, as I mentioned, is around 50%, so meaningfully deleveraged. And last but not the least, the forex reserves, which give us 8 to 9 months of import cover. So I think you take any metric, there has been a phenomenal improvement. And but for any geopolitical, I think this will further get more robust is the way we read it. Next, please. So again, even as far as the government positioning, I think we are positioned very, very favorably in comparison to so many countries globally. Banks, the biggest base and the biggest industry across indices, has seen a major cleanup and again now ready to take off. So we have witnessed a major turnaround in the PSU banks. The balance sheets have improved meaningfully from a loss to a write-off situation. We have also, with the help of the government, they have merged a few banks and taken the pressure off. Because remember that in any growing economy, the first touch point is banks, because the financial space will witness the first touch point in any growing economy. So clearly, I think the cleanup has helped. The private sector banks are already doing well. And now, in combination with digitization to offer various products, I think this space is again getting very exciting, because not only has a cleanup happened, but the ability, the speed, and the differentiated products that they will be able to offer and suit your needs is going to be again very exciting. So clearly this space is really holding the entire edifice. And again, household balance sheets, I think we are by nature more savings oriented as opposed to many other countries. And as we traverse this journey, we are at 2,500, 2,600 per capita GDP. In a year or two, possibly we'll cross the important threshold of 3,000. Another important point would be 5, and 10 to 12 is the average for us traversing that. This pole might be shifting every year, but give or take, I think we will then be a significant market. But as this journey happens, the growth rates for different industries will be meaningfully different. And so this entire journey will, kind of unfold many new exciting opportunities for various kind of industries. And to top it, we will be soon be having in a year or two even a very robust 5G application. Now the robustness of this is that you will witness upwards of 150 Mbps depending on the handset. The kind of download speeds that we will witness will be just amazing. So I think all these will kind of culminate into we witnessing a paradigm shift than what we have seen in even recent past. Next, please. So clearly, I think, India is positioned amazingly well in terms of the working population. Almost upwards of 50% will be in the workforce. A diametrically opposite situation to China. China, which has grown post the 80s at almost 8 to 10% for three and a half decades, is forecasted to grow at a very insipid level of less than 3% into the future. Internet penetration, we are the second largest now in terms of mobile penetration, organized retail, urbanization. All these are like amazing trends, very strong trends. Underlying shift are phenomenal. Even after so much progress, let me give you an example of the AC industry. Just to give you an example, no recommendations, but still after 75 years, we have only managed to penetrate only 12% in terms of the population reach that the AC industry has influence on. So I think I'm just giving you the runway for so many of these industries is going to be just mind-boggling. And as a corollary and as a natural corollary to that, I think some of the industries are going to witness such a huge and strong growth that, that journey of wealth creation is going to be one of the best that we have ever witnessed in our lifetimes. Next, please. So just to reiterate the point earlier that I made, the GST collections now are more or less stable between 1.4 lakh to 1.5 lakh crores. And partly this is an offshoot of the formalization of the entire economy. And this will further get emancipated as government keeps on tweaking the limit for GST. So I think you will see one more leg of GST collections going up. And on the right hand side, the digitization, I think the world is watching us because I think this is one of the biggest and one of the largest. So starting with Aadhaar, UPI, ONDC, and so on and so forth, I think so this has unmatched pace, unmatched power, and it will keep on unleashing new and new models also. So not only does the entire, and if you overlay the blockchain technology and such other features, I think we'll witness a paradigm shift amongst the most powerful, you reaching masses with almost no effort at all. And somebody as advanced as Germany to even implement a DBT kind of the direct benefit transfer has already gone on record that we'll take about 3 to 4 years to implement such a system if we have to do the same in Germany. So imagine that, the government has taken mind-boggling steps. We witness it daily, but, somewhere surely, but very firmly, I think the ground is being set for that big takeoff for India Inc. as a whole. Next, please. So Sensex, again, of course, this is subservient to, we will witness various gyrations, but, somewhere it has come back very strongly. I think the compounding machine is only going to be further emancipated and possibly setting it right for the next best journey that we are likely to witness, in our opinion. Next, please. So coming to the portfolio, again, earlier Rajesh had mentioned that we would, seeking some way to build the portfolio. Next, please. So we would want to achieve diversification. That's an important parameter. Sectoral approach. We would want to balance out the sectors. Deploy money even in debt if there are no opportunities, or for time being there are visibly no opportunities, no meaningful bias towards any market cap or sector. But the last point and the most important point would be growth at a reasonable price. Now, this is an acronym used very commonly across, but what essentially it means, and this at a very grassroots level, is that the value of which is, let's say, $1 and today available at 40 cents or 50 cents, needs to be captured now, and surely with the overlaying valuation principles, risk parameters, and overall growth metric that it needs to undergo to give us that necessary alpha. All this in a combination is what is finally coined as growth at a reasonable price. So even if we go wrong somewhere, it should not be punitive. By and large, our framework is designed to traverse this journey and capture the entire decent upside and generate alpha. So clearly, I think this is at the cornerstone of our strategy. Next, please. So clearly a three-way, very simple approach without too much. So, in accounting parlance, they say the more minimal journal entries that your books of accounts has, the more simpler is your approach and the more cleaner you are. So I think we wanted to break down the approach very simplistically. First, get the macro right. With the macro, get the sector right. With the sector married to the micro, which is the stock selection. And once that is done, bucket it very nicely so that again you overlay liquidity and sanity reasonably well. Hence, bucketed between large, mid, and small tactically. Finally, the outcome should be a great amount of or a decent amount of alpha. So that's what it is. Next, please. So again, I think somewhere the points will get repetitive. Sorry for that. But again, we need a strong eye on the emerging themes, the economic right, emphasis on valuation, again, marry macro, micro, all of that. And again, also be meaningfully aware of the expected tailwinds. I think this last point is very, very meaningful because, the amount of tailwinds that can come up and throw surprises is only growing by the day. So unless we have an holistic approach to valuations, holistic understanding, this last point cannot be eliminated, and hence that causes a slight more volatility to the portfolios. And we hope to, further tighten our processes to kind of take care of this. Next, please. So again, this overlay is also very, very important. We want to be in the right space, reputation of the management to resurrect and funnel the growth, good quality of companies with reasonably strong prospects, and improving, kind of size of opportunity, and overlaid with the valuation principles and the risk parameters will finally lead to the outcome of us building a strong portfolio. Next, please. So clearly, again, this is somewhere slightly more repetitive. Market cap, again, like we said, we would be wanting to orient towards market cap, which, kind of encapsulates all the principles that we have laid down. And we would be bereft of any market cap bias or a sectoral bias. But clearly, the eye would be on the alpha generation and superior returns. Next, please. So agility, diversification, risk, and tactical bets. Again, only a repetition of the earlier arguments, but yeah, that's what it is. Next, please. So I think, if you observe any successful AMC, I think the main cornerstone of any AMC being successful is, having a strong philosophy of investment and resurrecting, reinventing, and relaying surely but superiorly again those processes, those overbearing valuation principles within the risk parameters for a superior outcome. I think we can't, at any point in time loosen up the processes. We want to further cement the entire processes. And with Rajesh coming on board, I think, and the team uh, almost being resurrected, I think we will possibly meet or we are better geared to meet all these challenges and develop a very, very robust investment. So clearly, I think so. We have already witnessed that in the performance, and we further want to, as the team on boards, further want to accelerate that process. Next, please. So many of you would be excited to, kind of what are the sectors, really broad sectors. The entire, the entire paintbrush is open for us. Chemicals, textiles, infra, cap goods, real estate, durables, and auto ancillary. I will spend, one line. Chemicals, I think clearly today the world is looking at meaningful and a sizable opportunity from China plus one. So this is one sector that will benefit. Textiles, we are amongst the lowest cost and the best cost producers. We are the largest, let's say, terry towel supplier and the bed linen supplier to the world. And of course, even in the apparels, we are among, I think, second. But partly it is an outcome of the favorable duties given to certain countries, but for which we would be equally, if not better. Infra, again, I mentioned some time ago that the states would be spending, and we need huge amount of spends. Today, the world has an average of about 5 to 6% in the infra as a percentage of the overall cost. We are at about 12 to 13%. So this needs to be meaningfully down. And if you step back, I think the government laid stress on developing, the inland waterways and so on and so forth. The huge infra development by way of highways, roads, and a record construction of roads, which was upwards of 40 kilometers a day. So those are the reasons that the government was wanting to work at a breakneck speed. Cap goods, of course, will, as corporates do, after deleveraging meaningfully, they take a look at the new opportunities. I think they will further invest in automation and also enhancing capacities as the demand goes up. Real estate, the offshoot of many other sectors, has already been felt by real estate. Real estate, we saw a record stamp duty collection of 95,000 crores annually, and this will be a very strong theme. The only thing that can put small breaks would be the interest rate. But that said, I think we have not witnessed any slowdown in the real estate. We are witnessing strong trends across geographies. And consumer durables. So as an offshoot of the real estate, consumer durables also is likely to, because it's a natural phenomena as nuclearization of families and more houses are built. You'll need all of these, and also an offshoot of the chip availability, because that was causing a constraint in both autos and durables. And lastly, I think we are the third largest auto market very recently, and this will only be further going surely but strongly. And the entire ecosystem is there. We have some world-class companies like Motherson Sumi. That's again not a recommendation. I'm just showing, because somebody like a Motherson Sumi is catering today to the top 10 world car manufacturing groups. So clearly, I think the entire corporate India is also kind of looking up and meeting the demand that is coming out of the environment. And we have some very strong and very fine businesses that are built. Next, please. So the benchmark would be Nifty 500 composition, and financial services by far is the largest sector, and followed by IT, oil and gas, and FMCG. Next, please. So time and again, many stalwarts have overlaid the principles that, this is not a 100-meter dash. This is not a 200-meter dash. Investment is all about allowing your money to grow in a reasonably longish period. So if you observe this chart, I think look at the way probability has improved post fifth year, and post fifth year the probability of positive returns is almost 100%. Not only that, I think 5 years in a way is a one business cycle, and in 2 business cycles, I think you not only enhance your returns, but the probability is close to 100%. So clearly, I think the longer you stay, longer you allow your money to grow. We have seen even great compounding in the SIP returns and so on and so forth. So clearly, this is further cementing that view. Next, please. So this is almost a repetition, and we will go across asset classes as per what we think is judicious at that point in time. Next, please. So Rajesh is likely to head. Me along with my colleague Rohan are the fund managers. Possibly we are looking at further tightening and further strengthening the team, and very soon we'll have a very robust team. So clearly, I think so. The team importance cannot be again at any given point in time be designified. I think this is the most robust part in a people's business. I think so. We need some excellent people who will support us in this very exciting journey. Next, please. A different coinage: safety of margin, quality, and leverage. So this is already to a great extent covered in the growth at a reasonable price. But yeah, I think this is one more coinage, but I think we have covered this. So again, different buckets of active market cap allocation, active risk management, GAP, sector, and active bottom-up selection. If we get the initial phase and the processes right, I think that helps us in the last bucket, which is the active bottom-up stock selection, and that's the most important as far as we as investment team are concerned. Next, please. So yeah, I think again most of these have been covered. I'll just spend a minute. Internally we want to kind of have valuation metric which is very, very objective, very, very refined, so that in that journey of our discovery of great business bets, where we feel they are available at a reasonable discount and a great margin of safety, we want to ride the entire journey. So it's not going to be a very high churn portfolio. Nevertheless, just in case the situation so demands, it may. But overall, I think so. We want to be agnostic to the market cap bias and also the sectoral bias. We want to concentrate significantly on the bottoms-up approach. Next, please. Again, all the processes that is subservient to whatever I already mentioned, the quality parameters, the management, and all of that. Next, please. So this also has been covered, and the final outcome needs to be great companies at cheap valuation should not be missed, irrespective of the overall market situation and valuation. So clearly, this is the bucket that will enhance. And to just recap what Rajesh had said in his presentation, is that the great journeys of when the market cap shifts happen, when small cap becomes mid cap and mid cap becomes large cap. I think those are the pockets where functionally and fundamentally large market cap alphas are created. So we want to be always aligned and always be aware of those opportunities and capture as many as possible given our robust processes. Great, I think so. I'll just hand it back. Thank you, ladies and gentlemen, for a very patient hearing.
Thank you, Rajesh sir and Dhiman sir. It was truly insightful. We have few questions from our partners. First question goes to Dhiman sir. Dhiman sir, what is the three-way strategy of ITI FlexiCap Fund?
So clearly the sectoral which is the macro, getting the sectoral piece right, then marrying it to the macro. And after the macro, the bottoms up approach, which finally resides in a robust stock selection. So I think this will keep on repeating surely and more robustly as our, kind of entire understanding of the entire companies is because today, understand one thing, that let's say if you step back 10 years ago, the models were only as much. Last 10 years has seen a further enhancement of new models emanating. And next 10 years, you will see further dramatic improvement in the kind of new models, So always your microscope will need to be that much more enhanced, and you will need to have really well-defined way you look at a company. And that's where we are coming from.
Thank you so much.
We have a question coming up for Rohan. Rohan, what is the approach to the stock selection in this fund?
Thanks, Sadanand. So within our SQL framework, which Hemant already mentioned, we look at good quality companies who have above average growth prospects. Secondly, we also look at companies that are facing a stable or an improved industry scenario. This may be either because of the nature of their business or due to the superior strategies that are being followed by the management. And thirdly, we look at companies which pursue a strategy to build strong brands for their products or services and which are capable of building strong franchises. And on top of that, of course, we look at the reputation of the management and their track record, the financial strength of the companies based upon key financial parameters. And lastly, we look at the valuation parameters and the liquidity of the stock as well.
Thanks, Rohan. Rajesh sir, we have a question coming up for you. How does FlexiCap fund fit into the asset allocation basket of the investor?
Right. So basically, the FlexiCap, as you've already seen, invests across market caps. You can have large cap, mid cap, and small cap portfolios. And now it gives enormous flexibility to the fund manager based on the opportunities across these market caps that he sees to optimize the portfolio. And that flexibility it kind of weaponizes him to find the best risk return in the market. And that's the reason why we need to invest in a FlexiCap portfolio, because it's the best optimal mix across market caps.
Thank you, sir.
Rajesh sir, you had also mentioned India is an oasis in the desert. Can you please elaborate on this India growth story?
Yeah, I think we must know that when you look at India, not only from an India perspective, but also from a global perspective, you would see that there are very few countries, if ever, and in fact, the entire world is looking at India, a $3.5 trillion economy growing to 7 or even eventually $10 trillion economy. Now, the confidence in India is because the visibility of that happening and the certainty of that happening on a relative basis is far, far better for India relative to the rest of the world. So you're getting a large country, which is going to be the fastest growing economy in the world. So that is really what the India excitement is about. The second thing is, as Hemant also pointed out in his presentation, the corporate sector balance sheet is robust. They have a very low debt equity ratio. The bank balance sheets are extremely robust, right? They've come off a very large NPA cycle and they're all ready to lend. The consumer balance sheet is again extremely robust. That forms the construct of a new credit cycle. Banks will lend, corporates will borrow, consumers will borrow, and that leads to a increase in the economic activity in a credit cycle. So that's what the excitement of India is. Third, I think it was important to observe that a lot of work has been done by India, the fruits of which we're going to see as you move forward. Whether it is GST, whether it is RERA, the bankruptcy code, tax law changes, being a reduction in tax laws, all of the benefits of these are to come. And that's the advantage that we're going to take as we move forward. And lastly, as you have this credit cycle and the ingredients of what I mentioned benefiting India, you will have a growth cycle in profits. And as we know in stock markets, stock prices are slave to profits. As profits grow up, so will stock prices. So it's a very exciting time to be in India, really.
Thank you, sir. Rohan, we have yet another question coming up for you. What are the global factors that could affect the India growth story?
I think the answers are somewhat obvious. The Russia-Ukraine conflict has not yet been resolved. So we don't know if it continues for a longer period of time. Any further supply chain issues might crop up in the global supply chain. Secondly, crude prices are cooled off from the peak, but if they start rising again, then that could have an impact on the Indian markets. And I think the third and most important point is that to counter inflation, the Western economies have been taking sharp interest rate increases. If they are not able to control and get inflation under control in a relatively near term, then the interest rate cycle may eventually have an impact on the Indian markets and the Indian growth stories in the near term as well.
Okay, thanks. Dhiman sir, here's a question for you. What are the promising themes that you look forward to invest in ITI Flexi Cap Fund?
Yeah, so these were just mentioned some time ago. I'll just repeat those. The chemical space, the auto ancillary, the infra, the real estate, and certain cap goods. So I think the entire basket is offering, and textiles, of course. So the entire basket is there, and there can be very exciting opportunities within each of these buckets. And as time unfolds, so as Rohan just mentioned, that we don't need, we just need a smoother curve in terms of downward inflation and no geopolitical upset, but for which I think so some of these models will really show their prowess and ability to grow meaningfully large, and to address not only local size of opportunity, but today I think corporate India is also ready to kind of take advantage of the huge global opportunity. So clearly I think the runway is huge.
Thank you, everyone. Rajesh sir, requesting you for your closing comment.
When I get up every day in the morning, I'm really thankful that I'm born in India and I'm an equity investor in India, because it's an exciting time to be an equity investor in this country. Because like I pointed out, the certainty and the visibility of how our country will move in the next 3, 5, 10 years is the greatest relative to the rest of the world. So it's going to be an exciting time. And then we are bringing an NFO which focuses on FlexiCap, which allows the fund manager to optimize the portfolio construction process based on the opportunities that he sees across the 3 market caps. So it's a great time to be in India and a fairly opportune time to invest in ITI FlexiCap Fund.
Thank you, Rajesh sir. Sudhir sir, requesting your closing message for our dear partners.
Partners, I really assure you that our team is committed and will provide you the excellent investment experience to the investors. Once again, I thank all the partners joining this event and looking forward for their continuous support to this NFO. Thank you, partners.
Thank you very much, Sudhir sir. Thank you very much, Rajesh sir. This brings us to the end of the launch event. And as Rajesh sir rightly mentioned, it is the time for our investors to avail this opportunity and mold your portfolio. Dear partners, we look forward to your continued support in taking this new offering to every household. Thank you all and wishing you all in advance happy Makar Sankranti.